Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, October 17th, 2025. It's 2:04 p.m. Eastern Time as I'm starting the video, so we've got a couple hours left in the trading day. This video will be a bit different. I'm going to reply to a question that was put to me in the comment section, so I'm going to start there, go over the comments, and talk mostly about the credit market, something I've been talking about a lot lately. I often state, how you cannot overemphasize the importance of the credit market, even the bond market, which is bigger in its entirety than the stock market. A lot of pros, a lot of old seasoned investors watch the various subsectors or subsegments or whatever you want to call it of the credit markets for kind of a tell on the stock market. Whether, again, I know a lot of you don't want to trade bonds. It's like, most people think they're boring. They don't move a lot in percentage terms. I always say it's simple. If you want to trade treasuries or corporate bonds or whatever, you can make just as much money or more than the stock market. It's simply about getting it right or wrong, and then taking the right position size to accommodate for lower volatility. I call that beta adjusted position sizing. If I'm going to trade natural gas or GDX or Bitcoin, I'm going to take a smaller position than I will on, let's say, SPY or QQQ. Likewise, if I'm going to trade treasuries, I take a much larger position because a big move, a single day move in treasuries, in the 30-year bond, 1% is a pretty good move. It can move more, but that's considered a pretty big move in a day. And so unlike the stock market, it can easily drop 3-4% a day. So therefore, you can take 2-3 times the amount, and you're risking or attempting to make the same in dollar terms. That's what it all comes down to. Don't get tied up in percentage terms on a trade like that Beyond Meat trade, and you hit about 100% a day. But you don't put that much into a gunslinger trade. You don't put the same amount you'd put into General Electric or Apple or anything like that. So because your loss potential is a lot higher. All right, so let me dive into this. And again, if most of the videos I do will include actionable and timely information on trade ideas. In other words, watch this. Here's breaking down. The sector's breaking out. Here are the ones I like. And this one I'm just going to tell you is more of an educational one. So I'm going to go over the various fixed income classes. And the takeaway is probably as good or even better for an investor than an active trader. An active trader is going to go off the charts. Doesn't matter what credit spreads are doing or what kind of red flags are screaming the credit market. If you're going to trade the stock market or QQQ or NQ or the futures, you need a sell or buy signal on those based on their charts. However, once again, for investing, longer term stuff, this stuff does matter, and it can, what I'm going to go over, if you start to see an unwind very quickly, we've already seen a little hiccup, as I've talked about before, kind of was predicting, and we kind of got it, what I call fissures. Maybe a little bit more cracks now that Jamie Dimon kind of came out too with his cockroach analogy, and now it's being written about, so more people are being aware. Of course, today's a little relief rally. Again, covered that in the last video, to be expected. All right, so let's dive into the charts, and let me start out with this post. And I just wanted to let everyone know that when I just to keep things streamlined, I'm all about efficiency. I don't like very busy charts. I don't like a lot of fluff in the threads. Let's get down to business. So I'll usually just thumbs up when I get thanks or kudos, something like this or something I like. So just I got your comment there and gave you a thumbs up, as did somebody else. This one, same too. This is congrats on that. Remember, on the UXV long, we pretty much hit the first target yesterday. We hit it on the VIX. We've been hitting it. The VIX has taken out the 2192 target. These are the targets I gave you. They have not been modified. And so to a perfect hit, I guess perfect, close enough for government work. We had a high in the VIX of 2543 versus the 2527 target. So yes, just like when we hit the 2192 target the first time, we had a pullback. So it made sense to book some profits if on the VIX. Now, it could have blasted through there, but it didn't, because the markets are still holding above those Friday lows. And then the VIXY, again, it's not going to do a perfect job, but for all intents and purposes, you hit, I always say sell below. If you're new to the site, and I repeat this often, these are the actual resistance levels where reactions are likely. I always will sell a long positions a little bit below. So if your plan was to book profits at T1, that's effectively hit. That's close enough right there again. And why? Because traders will see a level like that, and quite often the sellers will step in early. But based on what's happened here, I fully maintain, and I'm sitting tight. These are great buy signal in the VIX. Again, sometimes you get a little poof, and that happened back then too. And I addressed it at the time we hit the first target. We had even a bigger pullback, but then we went on and hit the second target. So either way, I still think there's a good chance of hitting these targets. But as I often say, resistance is resistance unless taken out. So you need to break yesterday's highs in the VIX, which will most likely correlate with a break of yesterday's lows in the stock market. Okay, back to the trade ideas. Let's see. Okay, yep, just clicking. I just thumbs it up. The things that aren't really a question, really just comments. And Herman Munster continues, and I thank you very much. Thank you for this. Giving a real-time update in the sector, I believe it's trucking, automotive chips and all that stuff. So I very much prefer this kind of thing, because sometimes maybe it's in the media, like there's a link to an article, but it's buried down and I don't see it. So please keep those coming. Anybody that's in an industry that might have some insight that we're not hearing about on the mainstream media, please let us know, bullish or bearish. I'm especially bullish. I don't want, the last thing in the world I ever want on this site is a bunch of minions that see things with everything I see, whether it's gold, commodities, bonds, interest rates, the stock market, and a bunch of minions posting the same stuff, whatever my viewpoint is at the time, bullish or bearish, right? So I welcome and encourage differing viewpoints and supporting evidence. All right, so this one, let's just do the video on this. Reloaded asks, please cover the price action on bonds and related ETFs, and if you could explain how those could be used to predict equity/index directions. HYG, that's a junk bond ETF, the 10-year Treasury bond ETF, another junk bond ETF, investment grade corporates. Those are the TIPS, the Treasury adjustable rate Treasury bonds, and inflation linked is what they call it, TLT, the 30-year. And then, of course, it's kind of redundant, but these are all same thing. So basically, Treasuries, corporates, both investment grade junk. So I'm going to talk on that. But where I'm going to start is because so for those of you not familiar, this is just basic economic financial markets 101. You have credit and equity. Equity is ownership in a company. If you buy a stock, publicly traded company, you own a piece of that company. If you bought every single share, you own the entire company. If you bought over 50% of the shares, you have a controlling interest if they're voting shares, and you can then start doing things with the board and influence the direction of the company. That's equity. So again, you buy every share of Amazon, you now own the company. Bezos doesn't anymore, but he'd have to sell you his shares. So that's how that works. And then there's debt. Those are bonds, IOUs. A lot of public companies, not all of them, but most of them will issue bonds. And so we're going to talk on that. Banks no, these are equities. These are stocks, ownership in the banks, but banks generate credit. I mean, banks do two things. They in the most simplistic view of the way they originally started, they take in money, and so it's safekeeping for your dollars. And they turn around and pay you interest on your deposits, your checking and money market and CDs, and they turn around and loan that money out at a higher rate to people to borrow, to make loans on cars, boats, automobiles, train, whatever. They're buying planes and business loans, and they're going to make more money on those loans. And that's called the spread. That's simply it. If they're loaning money at 6% and 7% on a mortgage right now, and they're paying you 2% on a checking account, then they're making 4 or 5%. That's typically. Now, they're, of course, with the repeal of Glass-Steagall, I'll talk on that a little bit in here. They're gaming the stock market, especially the bigger banks. The regionals not so much, but the big banks. And so today, these are the earnings that came out today. And just to give you a little background on myself, I started out after college. I was a business major, and then my first job out of school was a stockbroker at Merrill Lynch. I was and career stockbroker there. Then I went on, and the grass is always greener, and it was to work for Barnett Bank. This is right after, I'm dating myself now, but this is in the 90s, early 90s, when the Glass-Steagall Act came down. That's when the markets crashed in the Great Recession, the crash of 29. They crashed because the banks were fucking around with the stock market. They were taking people's money, putting it in the stock market, making money that way instead of the safe way. And when the stock market crashed, then the banks crashed, right? And there was a run on the banks. And so the government, for years, they set up, Glass-Steagall said, they're firewalls. You can no longer take people's deposits and game the stock market. And that went on for a long, long time. And then those walls eventually came down. And in the 90s, they started to allow banks to open their own. They were wholly owned subsidiaries. So I worked for first Barnett Securities as a stockbroker, Series 7 licensed stockbroker, and go into the bank branches. And it was a very nice gig. And that went on for a few years until in 1998, Barnett was acquired. They were the largest bank in Florida, by the way. They were acquired by Nations Bank in 98. Nations had to divest because Barnett was the biggest in the state. You can't have a monopoly or near monopoly. So the regulator said, okay, you must divest some of your branches. And they divested, meaning give them to someone else, sell them off to somebody else. And Huntington Bank, it was a bank still around. And they reported today. This is what's prompted all this, guys, by the way. It's not a long. So I went to the group at Huntington, which was very happy with. And then right after that, Nations was acquired by Bank America. And so we'll get to Bank America stock in a minute, but that's a big bank. So these are your regionals, and Huntington's still around, Cincinnati, Ohio-based bank. Very happy there. Ran all the branches in Lee and Collier County. That's everything from Marco Island up to the tips of Fort Myers, Cape Coral, Lehigh, wherever, and everywhere, Bonita Springs, covering those branches and working as the broker. So when people would come in, they would refer, and I would train the platform reps. Those could be men, but typically women. When you walk in the bank, they're there, and I would coach them and teach them and get them their Series 6 license so they could sell mutual funds for appropriate people with small accounts, maybe an annuity if that was appropriate, and if they had a larger amount, they would refer up to me, who was a broker covering all the branches. And then that was a great company to work for. And then this one came and grabbed me because they decided to get into Florida too. Another Ohio bank. They're based out of what did I say there? This is Cincinnati. They were Cleveland. No. Yeah, I believe that's correct, Cleveland. And this Cincinnati bank said, hey, we want in Florida. And the reason, for those of you not familiar, there's a road called I-75, major interstate, that comes down from the Midwest and brings those snowbirds down. It runs down the west coast of Florida. So this is the peninsula right here, the Panhandle. You have I-95 on the East Coast. That brings the snowbirds down from New York and New Jersey, and that's where you have them in Miami Beach and that area. I'm from Miami originally. And so the Midwest, you bring those Ohio folks and Michigan, they all come down that I-75 corridor to down here in Paradise. And so anyways, I went to work for that bank. Very happy there. Same thing, running the branches, all the branches in Lee and Collier. Actually, this one did they have Collier County? I can't remember. I believe so. And this one definitely also, those two areas, Southwest Florida. And then just a couple of years later, I get a big offer that I couldn't refuse from a bank called AmSouth. They were out of Birmingham, California. And this is a story, and this is one reason I left these regional banks. And that was great. And then AmSouth sold out to this company, Regions Financial. So I've worked for 3 of the banks that reported today in their brokerage programs as an officer for the bank. And that was the last one. And that was where I had been trading to the point where they were frowning upon it. And the compliance department said, you have to pick one of the two. You can't continue to trade as actively as you are because you risk violations called front running and other things like that. If I buy Apple, and then I got a big client, and he says, "Oh, Randy, throw in I want to buy $1 million of Apple," and he buys $1 million of Apple, and I went first, but I didn't know he was going to buy it. Then that's called front running, because they could say that I knew that order was coming. I put mine in first to beat the price run up from the big order. So anyway, so that's where I started doing what I'm doing now, and that was back in 2007, 6, right before the financial crisis. Very timely. And I just wanted to kind of go over that. So that's where my background comes from. And the benefit of working for all these regional banks that I've worked for is, and the big ones, is getting to know and working very closely with those, what we call our business partners, commercial lenders. We'd go out and do calls together and meet their clients. They'd meet mine, called cross referrals. Banks encourage that stuff. The mortgage lenders. So I knew the financial crisis was coming and profited very well from it, just like you watch the movie Big Short, because I was in there real time. I was in ground zero. They called Fort Myers, Florida, ground zero of the housing crisis before everything blew up. So we could see it here firsthand. I remember several branch managers at Fifth Third making good money quit to flip homes. They were making so much money flipping homes. Obviously, that didn't end well for them. That was, again, 2007. All right, guys, there's the backdrop. And so a lot of the regionals are reporting right now, and that's kind of setting the tone for the market. Today's a bounce back day for all the reasons I stated before, namely that a lot of the banks, the regionals, hit support, but they're down. Let's not forget, one day doesn't make a trend. So if today you're feeling remorseful that you have a short position, or, as I said, the VIX hit resistance yesterday. The market and a lot of stocks fell to support. So it's a day, if anything, to cover shorts, not to add to short positions. Now, this bounce, like all, will most likely run its course. It could be over. Maybe that's it. My final targets don't always get hit. Sometimes you only hit the first, second. Sometimes you don't hit any. You get stopped out. But this is just a reflexive bounce off good support. As I said, a lot of these guys hit their 200-day moving averages and or good price support. This T2 level was laid out long in advance before we even got there. Remember, we shorted this one on the breakdown up here. And again, that's one of the former ones I work for. So that's why I wanted to give you the backdrop and just kind of my background experience, and then I'll get to the question now. Let's talk about the credit markets. So the one thing you want to watch, I should say one of many, are credit spreads. And credit spreads are simply the difference between what low to no risk treasury bonds are paying. I call them low risk. When I was a broker, you were allowed to say no risk, but I didn't. There's always risk. Even the U.S. government, I have a high degree of confidence they're just going to keep printing money and basically devalue the value of the existing bonds in order to issue new bonds to cover the interest expense and all that. And that's what they call a technical default. You're not outright not paying your interest. You're just printing up, making up money to pay. So whoever buys a $100,000 bond today, 30-year bond, 30 years from now, that $100,000 is worth squat. It's worth 25 in the original currency. So you've actually lost money even collecting your interest payments. That's what that is. Now, you want to watch this. Credit spreads are, again, the difference between what the low to no risk treasuries are paying and what what we call junk bonds, anything below a triple B credit rating, are paying. And as you can see, historically, they signal long before a recession starts. In the past, they've told the markets something is rotten in the state of Denmark. The market's whistling and humming away. Think of the dot-com bubble. That's the dot-com bubble peaked in March of 2000, right about here in the beginning. The NASDAQ fell about 80%. The S&P was less because it didn't have all those bubble stocks in it, at least not near that same amount. But you can see that it took a while. Then the NBER, as they do in their infinite wisdom, come out in hindsight, and they declare a recession. Recessions, or at least the start of it, are always declared in hindsight. They use subjective measures, so you can't say exactly what's going to trigger it. But the old antiquated definition is 2 quarters of negative GDP growth. That's widely held as what a recession most likely is. But again, the NBER uses their own definition, and I'm sure that's going to change if Trump gets to control who's in there and what they're saying, and when or if they even declare a recession. We'll see what happens there. Okay, so that's it. So credit spreads, when the economy's humming along, there's very little risk. And what it has to do with, guys, is defaults. Those junk bonds they're called junk bonds, but they're still businesses. They're not complete garbage. Their businesses are operating. The doors are open. The lights are on. They're selling product and services. But they're just a couple bad quarters away or economic downturn away from shutting the doors, from not being able to make the payments on the bonds anymore, going into default. And that's why they call them junk bonds. So, but the risk of default is very low. And so, and we'll get to junk bonds in a second. Junk bonds are about the only the only fixed income asset class, the only type of bonds that don't trade depending on interest rates. All other bonds, corporates, investment grade corporates, treasuries, munis, they go up and down solely, or treasuries go up and down solely based on interest rates. It's a complete and unmutable inverse correlation. Rates go up X amount, they drop X amount because there's the credit risk factor's not there. Junk bonds are much, much less sensitive to interest rates and much more sensitive to the economic cycle. They're more concerned about if the economy turns down, because then the default rates start to spike. So if you're looking at the chart wondering why they're not responding to interest rate cuts or hikes or whatever, they're going to respond more to economic data. Because when everything's hunky-dory, the default rates are very low and steady, and then all of a sudden things turn. And this is what I talk about. This is why I do these videos. When things turn, they can turn pretty quick. And and it's always happened even before the market peaked. Remember, the recession comes long after the stock market's peaked. If you are waiting for Cramer to tell you, oh, we're in a recession, sell your stocks, you're already going to have lost half the value, right? So by the time you hear about it, especially by the time it's official, the stock market has long since peaked. The stock market is a discounting mechanism, typically looks 6 to 9 months ahead. So you'll want to see watch credit spreads. And, their trough is dependent, just like the VIX. At different points in times, there's a different trough, a different bottom. After COVID, we hit a new record low right there because nobody was allowed to fail. If you guys remember, if you owned a business, whether you needed money or not, Uncle Sam crammed it down your gullet, sent you checks, PPP, payroll protection plan. You just had to show one negative quarter out of the last 2 years and you got the free money. And people got checks. They didn't even have to fill out a form. You get stimulus checks. And so, and rent forbearances were there. So, it was just a time where there was virtually no risk. So it was a kind of a one-off thing. And then things normalized, but you can see we've remained elevated from where we were pre-COVID, right? Things tick back up. And so right now, this is what I'm going to tell you, because I always analyze these charts based on the most recent extremes. Again, like I said, in the VIX, there were periods where the VIX used to go lower or higher, but that doesn't matter. There were different dynamics in the stock market back then. There weren't the one-day, single-day options and a lot of other factors that have changed over time. So this right now, this is what I tell you. When we break here, now when that happens, will probably already be, this will probably start to happen. That is a massive base. A lot of people see it. Speaking again of Jamie Dimon, a lot of people listen to him, and he's a smart guy. You can say what you want about him, but he runs the world's largest bank, JP Morgan. He knows his stuff, and he's been saying it for a while, and I've been saying that credit spreads are artificially depressed. They're not reflecting, they're near historic lows, and they're not reflecting the potential risk in the market. And so it's one reason I do this video. I've been talking about this, and I think that's one thing that's kept the stock market as strong as it's been, is that these old, these new pimple-faced kids coming out of, with their MBAs now and going to work in the firms, they haven't lived through enough cycles, and they also don't understand the inner workings. I think all eyes are on this, and that's saying green light in the stock market. I'll tell you, right now it is. But if this turns, and it can go quick, watch this, especially for a breakout above these levels. But where I think the risks are, and they're being underpriced, like I said, are this time around, which is different, is the private credit and private equity, where again, public over the years, this has been, looking at, and it still does. This indicator compares junk bonds, which are the publicly traded junk bonds, to treasuries, which are also publicly traded. And those, treasury is a treasury. there's no question the reason they're considered safe is because the U.S. has unlimited taxing authority. They're always going to pay their bonds back, right? And even if they have to print money to do it, you're always going to get your interest payment and your principal back. That's why they're considered risk-free. And then corporate bonds are every quarter. They have to report. Every now and then there's a company like a WorldCom or whatever, and they're cooking the books and they're bullshitting what their numbers really are and where the losses are hidden, and then that blows up. But for the most part, they have to report. Now, as I've been stating, if I'm correct, and there's more shoes to drop, and private equity has been very lax on their lending standards and not on top of the existing loans they have, because again, First Brands and Tricolor, to them, came out of the blue, and all of a sudden, boom, these companies, huge, big companies, those are big loans, bankrupt, out of nowhere. And so if that continues, there's going to be that repricing. Like I said, private equity and private credit has swollen in recent years. And like I said, even the banks now have shifted money and they're investing in those companies. So as a way to basically off book invest in or profit from loans that haven't been vetted as properly as the loans on the books of the banks. So if private credit implodes, private equity has problems, then it will spill over to the corporate. Well, you'll see a repricing. And again, maybe I'm wrong, and this is something to watch for. The markets aren't tell you right now, we're not going to hit my long-term targets. The VIX isn't going to hit those higher targets I have unless this breaks out. So watch this closely. Just recently, you've seen an uptick in there. And remember, nothing goes up forever. Yes, there's been a little abatement. That's why the stock market's rallying today. But you've seen a clear turn. In fact, you could probably draw a trend line there, something like that right there, and see a breakout right there. And so if that trend continues, again, it's a very, very short-term, near-term uptrend, making higher lows and higher highs so far. So if this does this, that's probably that one little tick up past that prior high. And then each of these highs, that's where the market will take increased note. And again, this stuff can unwind fast. I've studied and traded the financial markets a long time, so watch it. And right now, this is not flashing a red or even a yellow flag. Again, when you look at it from this perspective, yes, credit spreads are and have been elevated, but when you look back at historic levels, especially in recent years, like I said, this is the area where things will really get interesting. And so this helps support the case that the markets could continue to rally into year end and beyond, especially if those two bankruptcies that we had recently prove to be one-off events, because it is very possible. Sometimes you do only see one cockroach in your house and you don't ever see another one again. You kill that one and you don't see another one for a couple of years. That is possible. It's just not the usual scenario. Okay, let's do it this way. Let's just start out with treasuries. I'll get to those different bond types that was asked on that question. And we'll start out with treasuries, and I'm going to share something I've been sharing for years now, my view on interest rates and the stock market. And again, this has nothing to do with really credit. This has everything to do with the relative level of interest rates. And this is not a subjective interpretation of the charts to me. It is fact. We're coming off or have been in at least the biggest secular bear trend. A secular is a much larger trend. You have little cyclical bull markets and bear markets within a larger secular bear market. And this is the yield on the 30-year bond. The 10-year looks almost identical. And they peaked, as I've talked about, in the early 80s. We had runaway inflation starting in the 60s and the 70s. And in the early 80s, that's when the central bank, Chairman Volcker, broke the back of inflation, had to take rates up to about, you can see about almost over 15% right there on the 30-year bond. And it did the trick. And this, again, is not subjective at all. When I say this, It is in all the textbooks, falling interest rates are bullish for both the economy and the stock market because it lowers the cost of capital, which spurs economic growth. And it also takes away the alternative because when you or me, or especially grandma, can get a 15% rate or even a 7 or 10% rate on her CD at the bank or a treasury bond, they're going to do it. Pension funds, my God, will do it. That's what they historically have done. And they've been moving into private equity because and the Fed has stated that outright, explicitly, not implicitly, that they've lowered rates. They did it in the financial crisis to drive money out of safe haven investments, CDs, government bonds, into stocks. So they intentionally took rates down to the floor in the financial crisis and back here and kept doing it to gun the stock market up. Because again, who wants to lock their money up for 30 years at 1%? Not me, that's for sure. Not many corporations, not many institutions. And so that has been a big, that was where it all ended in COVID. And then they injected a tremendous amount of liquidity. Now, yes, the stock market is at new highs and rates have gone up by every metric. They've taken out the primary downtrend line. There was a nice price channel there that ended with the nuclear response to COVID. But these things take time. Rates right now have returned to really pretty much normal levels. If you want to call normal, at least normal in my lifetime, when I started working for Merrill Lynch and the banks back then, that's CDs, that's where rates were back in the late 90s, early 2000s. So we're back to a more normal. This was an extreme, artificially low rates, too low for too long. And so this is where we're at. And so longer term, again, near term, hard to say. I could see us pull all the way back test that, or I could see us break out and run from here. If this happens, it's going to mean the next real bear market is going to be upon us a lot sooner than most think. If this happens, there's two scenarios, unfortunately. This has no alternative scenarios. I've maintained that, and I've been very persistent on that. If we break out above the recent highs in yields on the 10 and 30 year, that I absolutely cannot fathom, see, or think of any scenario that is anything but very bearish for the stock market. Market will probably be freaking out, in my opinion. And it could happen, we're in spitting distance of that. Now, we can go this way, and that has two possibilities. It's an organic, natural abatement in rates. Natural forces bring long-term rates down, which is supportive of the stock market and economic growth. Or the markets crash, we take out the recent lows I talked about, start heading down to the next targets. We take out the 200-day moving averages in the S&P 500 and NASDAQ, NVIDIA, the AI bubble bursts, or there's a problem in the financial sector, or any of these other, what I've been calling gray swans lately, because a gray swan is something that, people acknowledge can happen, but they don't think it will. But it's talked about and out there. So if any of those gray swans happen and take the market down, it is very likely to see institutions selling stocks and buying treasuries, which puts the yield down. They go into what's called a flight to safety bid. So there's two scenarios there. And I'm sorry to be, one could be means the stock market does that, the other does that. It's just what it is. And again, we'll look at the charts of the stock market. It's not like we're going to, see bonds doing this and, do one thing or the other to the stock market. Again, if and why bonds are going down will determine how my outlook will be on the stock market for those reasons at the time, if that makes sense. Okay, so there's the 30-year. Here's the 10-year. Again, this is a monthly chart, so it goes back into the, as long as it'll go. This is back in the 60s. This is that era of a secular bull trend in rates, rising rates, which peaked in the beginning of 80s. Out goes Carter, in comes Reagan. And then that secular bear market ended with those big spikes down through the channel where the big rounds of quantitative easing. And then, again, as I said, they hit the nuclear button when COVID hit. Everyone freaked out and panicked, all the government officials, central banks overdid it. And this whole fact the stock market has gone to new highs despite that is, again, if you put, you can have, if you're, let's say you're an emergency room doc and you have somebody come in and, they twisted their ankle, they're in a little pain. You give them freaking, enough cc's of adrenaline, they're going to jump off that table and run across the ceiling like the Exorcist. That's what they did to the stock market. So there's so much liquidity, so much was injected then, it hasn't worked its way out of the system. And that's what supported stock prices going up despite this back up in rates. But again, this was an extreme low, near zero. We're never going to stay there. But again, you're looking at rates pushing, as I said. If we break out, this is the 10-year, you're going to see rates, interest rates on 10 and 30-year bonds and on mortgages to levels possibly where we haven't seen them back into the 2000s or pre-2000s into the late 90s. Okay, let's speed this up a little now. Okay, so that's treasuries. Now let's talk about those other types of bonds. That's more direct to the question. So in the corporate world, I need a blank, something to draw on here. I do this kind of crude, but you have, as far as a company goes, think of publicly traded companies. You have, as I mentioned earlier, stocks, equity ownership, and you have debt. Now, debt can be in different things. I'm going to talk on that. On stocks, let's talk on the hierarchy of a company. So if a company goes bankrupt, because that's all what it's about, the big recessions, the big bear markets are plagued with a lot of companies going out of business, folding, filing for bankruptcy protection, going under, or restructuring, almost going under. Sometimes, again, you can file bankruptcy, and there's different types where you go into restructure, just shake off the creditors. But let me just do this for you real quickly. So the hierarchy of a company, if you have your company as XYZ, and let's say Tricolor, pick any of these, and you go bankrupt, well, there's a hierarchy, and I'm just doing this from memory here. It's you pretty much have to first pay off any of the outstanding liabilities, any creditor. So you have payroll, vendors, the IOUs, things, people that are waiting in line to get paid, customers, things like that. That gets first, okay? And again, you're going to have X amount of money. When a company finally goes belly up, if they do, let's say, pick a round number or whatever. We'll say you have $100 million, whatever. I wish I had a correct tool to draw this, but so that's what you have, right? And you're going to that money is going to go. That's what they have, their net equity, equity minus debt. So first I got to pay off all those in front. Outstanding short-term liabilities have to be paid off. Then you have what they call senior debt. So debt always comes at the top, and there's different tranches of debt. Debt, again, is an IOU. Think about a bond, a loan, things like that. At the very bottom are the stockholders or equity. And so it goes like this. So after the initial liabilities are paid off, payroll's made, all that other stuff, 401ks are funded the way they're supposed to be. Then you have the senior loan. I'm going to get to this too. You have ETFs for all these. You have senior loans or senior debt, right? These are often variable rate loans, and there's a lot of publicly traded. We're going to look at a few. I used to sell these a lot back in the 80s, 90s, and they were great investments when rates were higher. Then below that, you have the subordinate debt. Subordinate waits in line. It's below that. And the way it just works is 100% of these, if there's anything left after this, you got to pay all these loans off first because they're senior to these. Then the subordinate loans or subordinate debt, those could be the bondholders, and usually is. So let's just say bonds, corporate bonds. Once and only if they've received every dollar, and I'm doing this in a somewhat simplistic view, obviously credit markets, they can structure things a little, a lot of nuances. Once the bondholders, if and as they've been paid off in full, then they go to the equity holders. Now, at that point, if they got down to the bondholders and they paid off all the senior loans, but there was only now, $10 million left and there's $100 million of bonds at face value, you're going to get 10 cents on the dollar as a bondholder. Equity holders won't get squat, not a red cent. And when it gets to the equity holders, if all the bondholders, all the debt holders have been paid off, then you have the preferred. A lot of companies have preferred stocks. As the name implies, it's preferred. They must be paid first before the common stockholders. Common stock is what most of you think of when you buy a stock. If you buy NVIDIA, Microsoft, MFFT, NVDA, those are the common shares. They're dead last. There's not anybody behind the common stockholders. Everybody, all these folks have to be paid off first in full before the next one gets paid. And then if there's anything left over after all that's done, stockholders may get to see $1 on the dollar if there's a lot of cash, but rare in a bankruptcy. Or you may get 20 cents on the dollar, or you may get zero. In a lot of cases, stockholders are wiped out. So there's your kind of crash course on how the debt markets work. And now, again, cracks, fissures will always start, almost always start there first. And that's why you want to watch these things. And we're going to go with what those things are. I just kind of listed them there, but let's start with, well, stocks are last. Let's go down with the high quality bonds first. Oh no, let's even go, well, take it a step further. We'll go to the senior loans. I've been watching those. All right, so I have a whole watch list of senior loans. Again, these are things I've trading these for years, use them in the right times of investment. Senior loans, as the name implied, they're right at the top. But they're usually adjustable rate. So yes, when rates are rising, especially if credit the markets are not worried about credit risk, they're going to go up. That's where you want to be in a rising rate environment. When rates start to fall or credit spreads widen, because even though they stand at top, they still may not see a red cent, depending on the nature of what's left over after a company files for bankruptcy. And again, they trade well to the technicals, but that's the bottom line. So you want to own them in rising rates. Now, the Fed cut last rate cutting cycle. Remember, they started a cycle a year ago right here, and it didn't really matter. And they started out with a big 50 basis point cut, followed up with two back-to-back 25 basis point cuts. But this didn't shrug it. It said, okay, we're fine with that. And there it is. We went to, this went to new highs because the market at that time deemed credit risk low. Then what happened? Well, we had that bear market that started earlier this year. And then really when Trump's tariffs, that was when he probably stepped to the podium, these things plummeted, mainly on credit risk and everything else. But I just want to point this out, just like I did with the business development companies, which they also tend, a lot of those loans, not all, but most are adjustable rate. And I've heard these clowns come out in the media and say, oh, yeah, well, they've been going down lately because of the fact they're adjustable rates. The Fed just started cutting rates. Well, the Fed started with twice the boom. They started with a 50, or unusual 50 basis point cut back there. And I pointed that out, how the business development companies actually went up back then. So that negates that whole premise for the most part. This is, like I maintain, this is credit quality, and that's what we're seeing here. So the Fed, remember, the Fed cut rates back a month ago today, I think. And they went down a little bit, but they've really been falling here. So I'm seeing this sector also sliding right now. And again, I have to throw that little caveat in there. I know they're adjustable rate loans on most of these, but the initial, we all knew the rates cuts were coming. That was the pricing in of it. Remember, it was 100% certainty we were going to get a cut at the September 17th meeting. And once we got it, it was already priced in. But now this is what I'm seeing as credit risk now being priced in. This recent plunge, just like with the business development companies. That's not the only one in town. There's several. VVR, again, these are daily charts. You can see these things sliding, just like the business development companies, coming down to test the lows when everybody thought the world was going to stop spinning back in April because of Trump's rhetoric on how aggressive his tariffs are going to be. And then that was the whole cow down, Trump always chickens out thing. But look, so what's going on here? This is reflecting more than the fact that rate cuts might go down. Again, I'm seeing cracks, fissures in this area of the market that I don't think a lot of eyes are watching. I've been watching these guys for years, and I'm just trying to show you. Here's another big one, EFR, Eaton Vance Senior Floating Rate Fund, really starting to come down. So the market's rallying today, but I'm watching the credit markets, and they're not so far confirming that much, at least this area. So there's your senior loans. Next in line, once these guys get paid off, then you have investment grade corporates. And this is an interesting area of the market and one to watch. Investment grade corporates are anything rated AAA, which government bonds, usually, there's been a few times they didn't have that. But usually you're going to get AAA. Very few corporations get AAA. Then you go down AA, single, and there's little nuances, plus and minuses as well. And then you go to BBB. And then that's your cutoff for what we call an investment grade bond, meaning that you're more than likely going to get your money back if you buy that company's bond, even if they're BBB. Again, the word is investment grade. You can invest in it. You probably won't have any problems. Anything once you get downgraded to BBB, double B, and lower, then they're considered. It's a high yield bond, aka junk bond. Same thing. A high yield bond and junk bond is the same thing. And again, doesn't mean they're pure garbage. They're still paying their dividends until they go into default, and then you're gonna, it's gonna be D for default. And so this isn't showing any cracks yet. The thing about it, again, as I said, things can change on a dime in the credit markets. You saw it back here when COVID hit. And again, it was technically induced. You can just barely see. I can't roll back anymore on this. I have to go to a 2-day period chart. You can see right there. And we did it. We shorted corps back then because they had a beautiful trend line. They put in a divergent high. COVID, as I've said many times over, was telegraphed in the charts in advance. And they plummeted. And then the Fed came in and backstopped them. So you saw a sudden, fast reversal. That was unusual. They invoked emergency charters they'd never used before. And they came in to buy corporate bonds, even low-grade corporates, using emergency powers. But the technicals played out, and it was there. The correction was real. We hit it. We got out. We hit our profits. And then they turned around and bounced. So we'll watch this. And what happens is, in recent years, the vast majority of issuance, instead of being up there in the single A or double A categories, or even below that, we've had a lot of the issuance right on the line, right at triple B. And so the way this works, and this is why I do these videos, and they're long-winded, I get them out in advance, whether this is tomorrow or let's say Monday or 2 years from now. When there's a credit event and then it snowballs and there's other credit events, meaning, money market fund blows up a hedge fund, another big bankruptcy or series, and then boom, 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 it starts a domino effect. Do not underestimate how fast this can go down. And what happens then is, if you look in your 401k now, you're going to have bond funds in there. You'll have at least one. And you're probably, one of them or more will be called investment grade bond funds. And if you go online or tell them to send you the paper prospectus, which nobody reads, you're going to read in there that investment grade bond funds, the manager is handcuffed. He is governed, he or she, by that prospectus saying he can only hold investment grade bonds. So what happens if the economy abruptly turns, there's a credit event, all these triple B rated bonds, agencies will come in and start to cut them down to single or double B. And then what happens is there's, again, more money in the bond market than the stock market. All these bond fund managers have to then sell. They're not allowed to hold for any period of time. They've got to get rid of those bonds. And so it's a rush for the exit. They all start selling what was a triple B bond now because they lost investment grade rating. And this can drop, and often does, really fast. And then you're going to see junk bonds yields surge. When you see that the economy is turning, there's a credit problem in the market, so people will start selling junk bonds, especially institutions, knowing that defaults are going to spike. So yeah, you have a very attractive yield, but that yield comes with a cost. And if the things start happening very fast, you start getting defaults one after another. So you're collecting a nice 9-12% dividend yield on a particular issue of a junk bond in there, and all of a sudden, guess what? The company, sorry, not only do we not have the money to pay you the next monthly interest payment, we're stopping our interest payments. Yeah, we also don't have enough money to pay you back on the bond, or we have 30 cents on the dollar you're going to get when all this is said and done. So, all right, guys, it's kind of complex stuff, but it's really not that difficult. And again, if you watch these things, those signs like the credit spreads in different pockets, I think all eyes are on, as started out with, looking at credit spreads and saying, hey, guess what? This looks fine. Corporate bonds are holding up relative to treasuries. There's TLT, there's your 30-year, here's IEF, your 10-year. Okay, this looks similar to LQD, but the ones you want to watch are junk bonds, JNK, and right here, JNK broke down. I told you last week we broke this uptrend line right here following this divergent high. So the technicals are all there. That was a divergent high, and that's what followed. That was a divergent high. There's your sell signal. So to me, it looks like it's begun, and it's in the early stages, and a few are mentioning it, writing about it today. Most people are shrugging it off because we're still in a market where the dip buyers are conditioned. Again, one of the strongest periods of classical conditioning in the stock market you can have. It's similar to 1999 where they're just conditioned like Pavlov's dog. Buy the dip, don't worry. The naysayers are going to keep naysaying. You just want to keep buying every dip in NVIDIA and QQQ or whatever else. But and maybe this is a one-off event. Maybe these breakdowns don't stick. But there's JNK. The other one is HYG. They're just two different companies on junk bonds. And so what I'm seeing is they are now underperforming. This, guys, is that tick up that I started the video when I showed you the uptick in credit spreads recently, and then the abatement. So they came in, as they do, on the first support level I had, $80 right there. Created that back on 2024. And that's where I expect them. Look at that. It was a massive, massive, massive support. I had this trading range here. I created that, highlighted that a while ago. This is a trading range we've had on junk bonds right here. And the top of that is a very powerful support level. So I would have been really surprised if they didn't buy at least the first pullback to it. Now, if it goes, we re-entered the trading range, and I think we will. This is where I think things are probably headed. Then we go down here. And so if you start seeing junk bonds falling faster than treasuries, or even worse, junk bonds going down and treasuries going up, then that's the widening of credit spreads. And I promise you, the smartest of smart money on Wall Street, they'll be watching that. I think they've been watching it, but they've been dismissive of it because it's been low. And you got to give them credit. The markets aren't going to crater until you see spreads widen. It's not going to out of nowhere just crash. You'll start to see credit spreads widen, and it could be very quick and sudden, especially, again, if there's a black swan or gray swan event or one-off big credit event or any more that follow. Right now, as of today, the market's kind of dismissing those as little one-off events, and so keep an eye on this, and you have the levels to watch. And then the other one I watched too is Fallen. Fallen is interesting. Fallen is a junk ATF. These are bonds that used to be investment grade and were recently downgraded to junk status, and even they broke down. And so you can see it's a nice little beautiful rising wedge pattern. And let me jump over to, let me make sure I covered credit before I get away from it. Yeah, those are the things to watch. It's going to give you the hierarchy of how companies are paid off, creditors are paid off, both on debt holders and equity holders. I started the video telling you that, back when I was, Barnett Bank in 98 was acquired by Nations Bank, who then was immediately acquired right after that by Bank America. And so Bank America, one of the biggest in the country. JP Morgan's, I believe, a little bigger, but technicals are technicals. So this is a chart as far back as I can go on my weekly chart. I can go to monthly, but it's far enough. We're going back into the dot-com bubble right there, 2000. And you can see 1, 2, 3, 4, 5. Only 5, and that's 25 years, a quarter century history. And I've had 5 times that I can see clear negative divergence. Divergence on the weekly chart will build over years, not days or weeks, usually years or many months. And then I always say divergence isn't a sell signal. What is a break of nice support. So on that divergent high, the stock fell 95%. That's where they would have went puff, gone away, but the government bailed them out because they were knee deep in doing bad liar loans, and like all the banks were. Then we had in 2015, 2016, off a divergent high, a 40% drop. In 2020, 50% drop. 2022, a 50% drop. And here we are now. So again, this is what I do day in and day out. And I can either listen to the optimists that tell us why there's no chance or very little chance of a recession, why the banking system's sound right now. Even it came out, a lot of big banks say they're fine. Or I can look at this chart and say, let me update a trend line right here. I can say, well, and they say the definition of insanity is repeating the same behavior and expecting different results. Well, I'd say the inverse of that is, when you look at technical analysis, if you're repeating the same behavior and you do expect the same results, right? The opposite of that. And so all I can tell you is that divergence is not a sell signal. I'll zoom down. What's a sell signal? you go down to the daily chart, we broke recently, and I just drew it for you on the weekly. This primary uptrend line, this was our divergence line. Divergent 1 gave us a nice correction. We continued to make higher highs in price. The divergence got even larger, so I just drew it out for you on the daily. We broke down. We hit really good support. Again, I would be shocked and floored if they didn't bounce and buy it off that support. That was the all-time high, all-time high, all-time high, all-time high. Boom, breakout. That's very powerful. Back test. Second back test. So they bought it where they should have, but the measured target, if you take this wedge, the widest part of the wedge, is going to say at minimum this thing should probably have fallen back to the 200s. So I think this is a reflexive bounce. And all it did is make an equal or marginal new high, still divergent high. Indicators are still lagging. So based on not just this chart, but more so this chart, if these divergences play out, then we're probably looking at, you can just do the math, and that's north of a 50% drop on average. And that was in the strongest secular bull market of all time. Again, let's say I'm right about interest rates and we've begun a new secular bull trend in rates, rising rates. Well, then these are basically, these were cyclical bear markets within a secular bull market for both the stock market and Bank of America. So it stands to reason that the downs, the next trends can be even larger than that, which north of a 50% average. And you might want to, you can take away that. They'll never let the banks fail again. We know that. The government will come and do what they can to bail them out. So the 95 was an outlier. You can just go off these last 3 right here, and that gives you close to a 50% average drop. And the thing about it again is divergence. Sometimes it only takes about a year's worth on the weekly chart, and sometimes that played out for a drop that was about half of that or more, but then you pushed on, made a marginal new high. So we could see that again, do that, and then 6 months, maybe even a year from now, I'm talking about the same thing I am right now. So I take it all together. I'm based on what I'm seeing, I'm starting to see things unravel. It's very simple. I just need to see a little more downside. I need to see Friday's lows taken out in the stock market, and I need to see another leg down in the financials. I want to see the regionals take out the recent lows, especially XLF, and I want to see credit spreads start to rise. And if I do in real time, if and as that develops, that's going to increase my confidence that Bank of America is coming down here, right here. If you want to know where I think this thing's going, if this is the top, and if it's not the top today and the top comes a year from now, we'll just drop from a higher level. It's probably all about a 65% drop in Bank of America. Minimum right here, about a 51% drop. So I'll just do this now in this video, and then I think I'll wrap it up. Let me just make sure. T1, and I'm going to put the date here. So at one point we'll revisit this. What's today? October 17th. And I'll do the same for T2. So that's my first target. And if Bank of America falls that low, you can be assured the whole financial sector, and of course the whole stock market, with financials not only being the second largest sector, but also the grease that keeps the wheels of the entire economy and stock market going. If the banks are having problems, they're falling, they're going to tighten up lending standards, and you and I or mom and pops are going to have a hard time going out and starting a new business or hiring more people or expanding your current business. Oh, and this is, by the way, on the weekly I have it shown like this. This is a marginal new high on the daily chart over that previous high, and that is still part of the same divergence. There are smaller divergences within there, each of those which gave its, a correction. That was a divergent high. That was a correction, but this is just a continuation of that first drop, just like the stock market. So those are my targets. Okay, did that little thing where I hit the pause button and it was it didn't unpause. So I was just covering the different financial sectors, the KRE, the regional banks, and they all look like they've topped recently with sell signals to boot. Sell signal 1, sell signal 2, moving lower, took out the 200-day moving averages. KBE is the S&P 500 bank ETF. To me, this is a very clean chart. clean primary uptrend line, bearish rising wedge with a divergent high. Breakdown, back test, sell signal 1, set break of the first support level after dancing on it for a while, hit my second target, bounced back down, took out that second target, and now it's back testing the 200-day moving average right now from below that blue line. Took out the 200 last time right here, tried to back test it and regain it, couldn't, and then have one last leg down in its last bear market. Other than that, when you're, it's simple stuff on a lot of sectors. When you're take back the 200s, you're in a bull trend, you want to buy pullbacks to the 200s, whether it's the simple or the exponential. And then when you break them, you want to short rallies back to them, and then you want to buy when you're back above them, But, so watch this. Right now, you could say, you might give it the benefit of that, we're just testing the 200s. But if we take out the recent lows, you're going to have clearly lost the 200s there in the bank sector. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.